I'm going to chat to you real quick about life insurance, or as people call it, death insurance, because that's effectively what it covers you for. It covers you for death. Life insurance is effectively a sum insured that you choose. It may be, let's say, $1 million that you need. And you pay a premium that's decided by the life insurance companies over a period of time to fund that. And in the event of your death, and sometimes in terminal illness cases, it'll pay out early, but in the event of your death, that policy will pay out the sum insured, $1 million. So what people don't know about life insurance is that typically there are three basic areas in which you can own a policy. So we're going to run through some of the bells and whistles and the features of those right now. The first is in your own name, the second is in a superannuation fund, and the third is within a company structure. So each of them have different reasons for having them and different benefits and features. So let's have a look at buying it in your own name. So you're funding the policy through your hard-earned dollars, through the money that's in your bank account. Now generally it's not tax deductible in these circumstances, so you pay the full whack. The benefit is that you can choose whatever direction you want for that money to go, and generally there'll be no capital gains tax payable for that policy. So if you want it to pay to a third party that's a non-dependent of yours, no problem whatsoever. You can will it whichever way you like. The second way is within your superannuation fund. Now, within a superannuation fund, it is deductible, so there is a benefit that you get straight away. It's also not coming from your cash flow. So if cash flow is an issue, then this may be a very, very good way of protecting your family. What you do need to consider are the taxes associated with superannuation. Now, I'm not going to go into all of them at the moment, but if it's going to pay out to an adult dependent or perhaps a non-dependent, then you need to consider what the tax consequences of that life policy is going to be. But generally, if it's going to be for your spouse or for your younger children, then this may be a very, very cost-effective and cash flow efficient way of owning your policies. But be aware about the end tax considerations. And the final one's within a company structure. We deal with a lot of businesses at our firm, and what we've found is that most people don't understand that they can actually insure within the business. Now, whether you choose to claim a tax deduction or not will determine whether you end up paying capital gains tax or not, but that's something for you to chat with your accountants about. The benefit of this little section that we're talking about here is to understand that you can actually own that policy within the business. So you may own that for key man risk. So if you have a lot of exposure to a single employee, that if something happened to them, that they'd cost a lot to replace, or there'd be a lot of business downtime, you might want to consider that, possibly even for yourself. Or maybe you've got a business partner that you need to buy out. So if they pass away, you don't end up having their estate running your company with you. Anyway, there's the three things to consider about life insurance policies. So hopefully you didn't find it too boring. We'll catch you next time.